What's the Risk? Hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is a discussion on the realities of how passive or active indices really are, because there are a lot of active choices being made when indexing. So it's always an interesting discussion, especially when some indices have more and more rules determining their construction. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap the sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. So, starting here with what we need. What we need is a no-load minimum management fee mutual fund that simply buys the hundreds of stocks making up the broad stock market averages and does no trading from security to security in an attempt to catch the winners. And that's Burton Malkiel, author of A Random Walk Down Wall Street, a book that highlighted the very real issues with active management, forecasting, and stock picking way back in 1973. A broad market index would be the MSCI World All Country Investable Market Index, capturing mid, large, and small caps across 23 developed markets and 24 emerging markets, and it's got over 8,600 constituents. And it covers 99% of the global equity investment opportunity set.
Yeah, I think that this is a really important point, Daniel. This genuinely is a broad market index. 8,000 plus stocks across 23 developed markets, 23 emerging markets. Got 46 different countries in there. It's a very good representation of the global public equity markets. Sadly, a lot of indices that are promoted and or index tracking investment products are a really narrow subset of this. And I think that can, for a lot of investors, prove to be folly. I guess we'll touch on that a bit more as we go on.
Yeah, so that's what we need. And I'd probably argue that index managers are more catering to what we want rather than what we need. What we get is choice. And how many indices are out there? Well, people might be surprised to know there's over 3 million. And then...
Which is ironic. That to me, that's absurd. Now, some people will know my background's mathematics, but how on earth do we need 3 million indices when we don't even have 3 million companies? It's just absurd. I just sit here shaking my head when I see that, and I'm very confident that a lot of the resultant products created just don't survive.
Yeah, so you've got exposure to asset classes, investment styles, the factors and themes, index and index product choice. So there's active decisions, but we all have different needs, goals, and sometimes ideas. So you've got people who will go chasing those themes. Here are some of the decisions that you're forced to make as an investor because you don't get that all country world investable market index. So weight in each region. So you've got Australia, global and emerging. Then you've got large, mid, small in each of those. What's the weighting going to be? Which countries are going to be in developed or emerging? You're going to just focus on large caps or the total market. And when we say large cap here, the popular VAS VGS split is developed markets large to mid cap, and that's going to be around about 1,600 stocks in total. When we remember you're missing about another 7,000 with the MSCI World All Country World Investable Market Index. So further down, factors and themes, as you see on the slide there: tech, value, profitability, momentum, property, infrastructure. Look, you could go on forever. And what qualifies a stock for a factor or a theme, the index provider is going to come up with the rules that determine that, and the rules are going to differ.
Look, there are many good examples there of where those themes and rules include or exclude companies. A classic example, you've got ESG mentioned there. Australia's largest provider of groceries for the home, of course, is Woolworths. But some ESG funds screen them out automatically because they also sell alcohol. For an investor that might be somewhat Puritan and not want alcohol included in their portfolio, that's their choice that they might wish to make. But there's got to be an acceptance that might impair returns. Woolworths traditionally has been a pretty profitable company over a long period of time. The rules for making up indices and the rules for including or excluding is again almost an active management bet according to your beliefs.
And which index do you choose? And this highlights, well, you might be thinking, oh, I'll just add some small caps. I'll go with my favorite index manager, but the returns may vary depending on the index provider the index manager uses. Obviously, you can see the difference there in red on a calendar year basis between two different small cap indexes in Australia. I think there's three ETFs that track these different indices. One of them from Vanguard, I think the other by State Street and BlackRock. This isn't data mining, and it's not necessarily isolated, because you can actually find a similar effect happening with total market indices in the US, with the CRSP total market, the S&P 1500, Russell 3000, MSCI US IMI, and there can be substantial differences on an annual basis between those four as well, up to 3.2% it was in 2020.
It's an incredibly confusing concept for the average investor. Which of the indices do you want to have faith in? The differences there are really quite pronounced, and you can see the winner changes quite regularly. Admittedly, the middle row is the winner more often than the top row, but some of the differences are massive, and so the end result might be relatively similar. It might diverge quite a lot, but how does the average person actually understand which is the best one to follow, and indeed understand why?
So index providers and your goals, and the reality, index providers aren't thinking about you when they're constructing an index. They're not fiduciaries, and as noted in these 2 points, they aren't aware of what your investment needs are. They don't even consider it.
No, they're just a mathematical construct, and there's nothing wrong with that per se, but investors need to understand that the people designing and then overseeing the management of the index have no interest whatsoever in individual investors' needs.
This is how index providers make active weighting choices, and you can see the difference here between FTSE and MSCI with their emerging market indices. Now, China has a little bit more in FTSE, a little bit less in MSCI, but the notable thing is South Korea. FTSE includes South Korea in developed markets, while MSCI includes South Korea in emerging markets. Now, how you come to this decision, I don't know, but as you can see, there's no real consistency between the index providers when they're making these decisions.
For the average investor, there's little potential for them to truly understand the implications of that, and indeed understanding the implications of why the FTSE index decides to exclude South Korea, and then ask themselves the question, well, do I actually believe in that? What is it about South Korea that says we should exclude it from here?
Index provider active weighting choices, and weighting is in terms of time with this one, with the S&P 500, with some additions that went in. You can see the time when some of these companies were in the largest 500 stocks, but then they had to wait sometimes significant amounts of time before they actually went into the S&P 500. The cumulative relative performance versus the S&P 500 between the addition date and the first month they were in the top 500. And there's some returns that have been certainly left on the table while you've been waiting for these stocks to appear in the S&P 500.
Probably the most stark there is the Palo Alto networks, where there was a 58-month delay for it to actually enter the index. In that 58 months, the price went up a further 160%. So for every dollar of value that it had at the start of that 58-month period, it cost the fund $2.60 to actually get exposure to it 58 months later. A pretty significant price to pay.
Another point is index managers make active decisions to change benchmarks and chase fads. And ESG has been a notable one in recent years, and BlackRock's been a notable offender. But we can see here Van Eck dumped a junior energy and mining tracker in 2016. We probably know the reason, to become a mid-cap tracker. And the other three instances are BlackRock and State Street changing indices from standard trackers to ESG.
I have no confidence in these sort of decisions at all. This is about chasing fads that will hopefully allow the fund to grow to a size where it's viable for the manager to benefit from. I find these sort of decisions to lack any form of investment integrity at all. I see this and I'm actually horrified because the poor old investor starts with a particular product that he or she wants to invest in, and then they end up in something completely different, and it's not because of their needs.
I'd say the Van Eck MVE is probably one of the good decision there, given how volatile the junior and energy mining space is. I'd say that, I wouldn't say underperforming, it's probably tracking the benchmark fine, but the performance was abysmal up until the change.
At the end of the day, it might be tracking the benchmark, but if the investors are getting nominal returns that they're really annoyed with, as a manager, you've got two choices: either close the fund and give people back their money, because obviously it's not growing, it's not going to be of a size that provides scale to make it viable, or you change it to something else, which means the whole theme that the investors chose to pursue has just gone out the window.
Index managers make active decisions to chase fads and then close ETFs. So here's an example. Beta shares have a reputation for providing some really good low-cost products, but they also have a reputation for putting out some very marginal offerings. And when they don't take off, your ETF is getting shut down.
Online retail and e-commerce just ignores every other type of business that there is. Future of payments ETF, again, it's just, to me, taking a risk that can be diversified away so easily. That risk just doesn't have to be rewarded. The funds didn't grow, so it couldn't have been rewarded too well. The investor that was in them ends up getting their money back, potentially capital gains tax crystallized, costs to then sell out, buy something else. It's sad. To me, I've watched over a very long period of time when fund managers, investment managers close products, investors rarely get a good deal.
And index managers make active decisions trading, or we won't get too far into this one because it can get complicated, but just because something tracks an index doesn't mean there aren't trading decisions that need to be made. No doubt there's a lot of research that goes into this, but a lot of volume will go through on the reconstitution date, usually at the end of the day. And you know what that means, Peter.
Yeah, it means that the volume of trading on that particular day goes up dramatically. Because the volume of trade goes up dramatically, the spreads between the buy and the sell prices tend to widen, and the index managers that have to load up on a particular stock late in that day generally end up paying substantial spreads. And that's got to be detrimental, at least in the short term, to how that index will deliver for investors thereafter.
So you've got to make these decisions yourself.
It's the closest thing to stock picking that you're going to do. And if you pick the wrong indices that have been narrowed right down, it's not much different to picking the dog stocks that don't perform.
And sources and descriptions of data. Thanks for your time.